I'd like to thank everybody for joining us today with a mid-year revisit to our early February review of what our market expectations were and what our expectations for the risks that existed in the market. So today we're going to do this a little different than we did it in February when we talked really about how our managers had performed in 2023 and how our investments had performed in 2023. Instead, we will begin with talking about the macro situation with specific focus in terms of the activity in the market, in the inflation rates, in the economy as a whole, and the sort of glide path that we find ourselves on from that point of view. And then we'll switch and talk a little bit more about some of the macro headwinds that exist quite simply from the fiscal spending and so forth that the government has participated in. I do think it's important to mention that we had set both a bull and bear expectation, and in fairness, we have to recognize that we're above even what we thought on the most bullish side the equity markets would be at, with the S&P 500 over 5,500 at date. But I think one of the important things to consider in that is how narrow that rally has been, and really led by a few very large cap, technology oriented firms. And that certainly has some analogies to historic years as well, where we've seen activity like that before. But that certainly has led off. Volatile market in fixed income, yet we still find ourselves with a 10-year in the low 4.25, 4.3 range at this juncture. And there is a lot of political uncertainty too that we're facing. We're sitting here recording this on July 11th, and who knows, in a few days there may be more certainty or there may be more uncertainty. But we really have to think about how we're going to build portfolios that will be robust throughout those time periods. With that introduction, let me turn it over to Patrick Kenary, one of our advisory board strategists, and he will talk to us a little bit about the glide path that we found ourselves on and some of his expectations for where we were going to be that were borne out through this year, I think. Patrick?
Thanks, John. So for those of you that saw our February presentation, I think I just want to take you through some of the framework that I talked about then, because a lot of that has remained in place, but I think we're just further down that path. So if you recall in February, I had emphasized that inflation is probably the most disruptive long-term threat to markets. And, because it disrupts just the management of businesses and households day to day, it tends to hurt valuations. Higher interest rates mean a higher discount rate. And also, because it's so damaging, it requires a response from the Fed, which tends to be very disruptive in markets. They raise rates and maybe shrink their balance sheet. And so the Fed's countering of inflation is very damaging. So the thesis in February was that a lot of the major inflation risks had peaked and in fact had moved into the rearview mirror. And so it was allowing the economy and inflation along with it to move into what I referred to as the 72-degree zone. It had been maybe running hot for the prior couple of years, and call it 80 in the 80s, and it had to move down into that zone. And that tends to be the most positive environment for stocks, because as long as you maintain that growth level that's enough for earnings to be sustained, you're getting lower interest rates, and that allows for higher valuations. And one of the other points that I emphasized is The slowing that we've seen, it's largely concentrated in interest rate sensitive areas of the US, but also in global economies that tend to have more exposure to interest rate sensitive things. The most extreme is China, which has a very large real estate, has been a very large part of their growth for many years, but also manufacturing for exports. And so the process that the Fed had been on of suppressing inflation using interest rates in the US had caused those areas to slow down and was showing results, and especially showing results globally, which was creating a situation where you're getting the lower interest rates and the more favorable conditions for US assets without necessarily having a sharp slowdown. So that was the thesis coming in February, and it largely has been continuation down that path. I think one of the points that I made at the time was that probably the best thing for the Fed to do if circumstances didn't change is just stay the course. That the bigger risk to markets long term would be a premature cutting of rates and easing policy, because it would create the disruption and uncertainty that we had been living through for the prior 2 years. So where we are now is that inflation, while it had a kind of a hiccup in the first quarter, has continued on the trend of falling back to the Fed's target. It's still above target, but it's been falling back towards target. So we're on the path into that zone where it's a very positive environment for kind of a subset of the market. So those companies that are less cyclical, that have less exposure to interest rates, they are getting the benefit of low interest rates in their valuation, but the slowing economy is yet to really affect their performance. And that really explains the narrowing of the market that we've seen. Historically, when you get into this late part of the cycle, the market will tend to narrow as the more cyclical companies are struggling, while the stronger companies are getting the benefit of lower interest rates without the negatives to their earnings. So, and one of the things that's been very dramatic, just to illustrate this, is we have a chart of the S&P, which is now composed, a very large percentage of the S&P is now its top 5 stocks. Something like 25% of the market cap is in its top 5 stocks. And comparing that to the equal weighted version of the S&P, where just every stock is 1/500th of the S&P 500. And there's been a dramatic difference in performance in those over the last 6 months or so. So there's nothing really earth shattering in changing compared to what I was talking about in February, except that we are further out on that cycle. So we've moved from uncertainty about whether the inflation would at least be behind us for a time to where that has in fact been confirmed. And what the momentum of the economy has also started slowing. And while that doesn't sound that good, certainly to Main Street, an economy that is less likely to create inflation and to overheat is one that's typically better for financial markets. The risk is just typically the cycles, they are cycles, is that you're moving to where the highest probabilities are. If we manage to only slow modestly, you'll end up with what they call a soft landing, and that tends to be very positive for almost every stock. Or if things continue on this trajectory, there becomes a risk of a recession as things slow down and the interest rates that have really started to do their work. And I guess a final point on that is that typically there's a long lag in the responses of the economy and markets to interest rates. So the fact that nothing has happened yet, we have to be on the lookout for a slowing economy, because often it takes a lot of time for those high rates to flow through to economic activity. And I guess the final point, without going into much detail, is I think that is the sort of base case, is things just continue to slow. And the question is whether they tip over into recession or whether we manage to avoid that. But we do have an election that could be very consequential coming in November, and there certainly is a lot of uncertainty that around that about what that's going to mean. Especially, I think a second Trump term would not be continuity. So, with that, I'll turn it back to you, John.
Thanks, Patrick. And I think you do make a very good point there that, we sort of are on this glide path of a soft landing, but I would remind everybody that, months and a year and a half ago, we talked about how we had an inverted yield curve, and that tends to be a predictor of recessions. Not only do we have an inverted yield curve, we've also got an unemployment rate that's been ticking up. And there's something called the SLOM rule, which looks for a 0.5% increase in the unemployment rate over the previous 3 months as a strong indicator. So the big question we have sort of facing us, do we really have a soft landing or not? And that's the challenge. And it's part of what we've been focused on when we try to build the portfolios that our clients are invested in.
And I just one comment on that, John, is I would say that the concentration in what people would say are the highest quality stocks that we've been seeing become more extreme over the last 6 months is consistent with a slowing economy. As that data has come in slower, people tend to try to find companies with earnings that they can be more confident of. And so the markets have been consistent with that thesis.
I do think, and it's an interesting point when meeting with the underlying investment managers that we invest with, one sort of common element is most of their portfolios have high quality earnings streams, most of the companies in their portfolios, particularly the active managers. And that's, I think, an important factor we can talk about a little bit later. They don't always like when we say, well, what you're really doing is quality, because they think of themselves as either a value or a growth manager. But the reality is a lot of them are ending up in what we call sort of the quality names from that standpoint. So let's shift gears a little bit and talk with Thano about some of the fiscal and monetary risks that are sitting out there as well too. And I'll turn that over to Thano Hasiotis, who is an advisory board member and a strategist with us as well too, and works very closely with our investment team.
Thanks, John. Just to pick up on the glide path that we're on that Patrick outlined earlier, I think it's important to remember that we had a couple of things that were really helping the economy move along that we don't always have. The first would have been the sort of enormous quantitative easing that we had and the expansion of the balance sheet and the slow working of that process out as we wait for the effects of a higher Fed funds rate to slow the economy. At the same time, we continue to have very elevated deficits to the tune of about $2 trillion in fiscal 2024. In the short run, that's stimulative. That certainly has helped the economy continue to move along. And finally, we've had massive amounts of migration, whether legal or illegal. The fact of the matter remains that when you add that many people to the population, it is stimulative to GDP. So those three things have probably extended the amount of time that we've had while we sort of wait for the slowdown that everyone has expected, the higher Fed funds rate at 5 to 5.25 to have. Just to outline some of the risks that we have, Patrick mentioned and John mentioned the election. Right now, the odds strongly favor Trump, so I want to deal with that first. It's fairly easy to assume that if Biden gets reelected, that we probably have more of the same. If Trump wins, which the odds are putting that at over 70% at this point in time, there are several things that he has talked about that could change things. more specifically for stocks, but maybe not so much for the market overall. So the mix will sort of change in terms of who does well and who doesn't. The first is that when you look at the CBO's, the Congressional Budget Office's projections for deficits, they have the deficit shrinking post 2025 because they're under the assumption that the tax cuts will expire. Okay. Um, Even with the Biden administration, many of those tax cuts will extend. And under a Trump administration, he will seek to extend all of those. That will add about 4.6 trillion to the deficit over 10 years, or call it around 420 billion right out of the gate. That's about a 14% reduction to our tax revenues. On the other hand, Trump is um, very set on raising tariffs, both across the board of 10% and something like 60% on Chinese goods. These would roughly raise about 500 billion in revenues for the government without any behavioral effects. So net, let's just call it that one washes out the other. But if you look at that in totality, it does change sort of the impact. So that would be more difficult for consumers, but the extension of the tax cuts would be good for owners of capital and those reinvesting. It's a little bit almost like a supply side economics. That is traditionally that would have been very big numbers, but when you're running about spending a little over $6 trillion and you're bringing in a little over $4 trillion of revenues, it's not as much as it used to be. The final thing I'd like to talk about is risks with respect to the overall credit markets, particularly U.S. Treasuries. So far, everything has gone swimmingly well. The Fed has reduced its quantitative tightening or its selling of bonds from 60 billion a month down to 25 billion. And there's very little going on in the MBS market, mortgage-backed securities, because nobody's really refinancing at these higher rates at 15 billion. The market has accommodated that extremely well. I will point out that over this period of time, the reverse repurchase authority has shrunk from 2.4 trillion to 400 billion. So we're kind of done with that easy money coming off the Fed's balance sheet. And now the question is raised, how much of the reserves that are in the banking system, which are quite elevated from where they were before COVID, can come off before there's any stresses to the banking system, because that is something that the Federal Reserve will not tolerate and will quickly move to address that. It would get tricky if they had to address that and inflation still remained above their 2% target. But right now, as it stands, the appetite for treasuries remains good. But the risk is that when you continue to run $2 trillion a year deficits that might expand in a new administration, does that call for capital by the U.S. government come out of the capital markets elsewhere? Now, before I leave on that sort of more risky note, I do want to throw it back to Patrick about the idea that if we did have higher a Fed funds rate at this level for a longer period of time, that may not necessarily be bad for the United States. It might actually work in our favor if it results in a slowdown in the rest of the world, which would allow us to benefit from reduced prices that we import. Patrick, do you want to elaborate on that a little bit more?
So I'm not sure whether necessarily keeping the rate, whether it's 5.25% or maybe it's slightly lower, but the idea that because the Fed is able to maintain a higher interest rate than the rest of the world can, and the rest of the world sort of has to accommodate itself to whatever the US interest rates are, because the US is the reserve currency, that whether it's intentional or not, the policy of maintaining tight enough policy within the US to help reduce inflation here and to slow activity here will tend to have an even stronger effect in the rest of the world, because the rest of the world generally doesn't have as high growth as the US, but also they tend to be more heavy industrial economies that are very dependent, and those kinds of capital intensive industries are then more sensitive to interest rates being the cost of capital. And so the impact of the Fed's activities and of the Fed's rate hikes, especially in the context of very high deficits that we're running, so they're sort of counteracting each other. So the deficits are stimulating at the same time that the Fed is tightening. It has an effect on the rest of the world that can be more contractionary. And the interesting thing, you can either say they're exporting their deflation or disinflation to us, or alternatively, the US is exporting its inflation to the rest of the world, either in the form of the currency strengthening, which directly lowers prices for the US, or in the form of less profitable activity, just lower profits and more financial stress for the rest of the world. So I think one of the points I made in February that I want to come back to, because I think it's very important, is that I think there's I guess, a common belief that synchronized global growth is sort of the best of all possible worlds for markets. But if you look at the history, in fact, the US markets tend to do the best when there's other significant parts of the world that are struggling. So I mentioned this again back in February, but if you look at the late 90s, really most of the 90s, Japan went from being the second largest economy in the world at 18% of global GDP to right now it's less than 5% of global GDP. That slowdown and contraction in Japan, I think, directly stimulated growth within the US because it meant they're not demanding and consuming the same amount of resources that they were before that period. So it allows the US to grow in a non-inflationary manner. Effectively, it's freeing up resources and capacity for the US economy to consume. Similarly, we're seeing this effect in China, and I think it's actually explicit in China. So the Chinese had a real estate bubble on a scale that really nobody's ever seen in history that has cracked. It is now, on the bust side of the bubble. And they have explicitly said that the way that they're going to maintain their economic growth is to try to export more. Now, China is already the largest exporter in the world. So China exporting more is a direct deflationary attack on the competitors in those industries. The one that's gotten the most attention has been electric vehicles. China is become a very large exporter of those very quickly. It's creating a big conflict with Germany and the EU. And so that's just one symptom of this process that can happen where the higher rates in the US, they crimp demand and activity in other economies that are not able to function at those higher rates. And then that starts to lead to deflationary effects that spill back to the US and suppress our inflation rate. So it's something to watch. And I guess the final point is the late 90s in the US looked a lot like that. And I'm not saying that this is going to be a parallel period. But what I would say is those forces are very similar forces are at work as were at work in the late 90s, where US growth is faster than the rest of the world. And the struggles of the rest of the world to maintain their economic growth are in fact a benefit to the US because they allow us to grow with less inflation.
I think there's an interesting point here, and I do want to try and turn this to Amory and Rodrigo to spend a little time talking about our portfolios. But you bring up an interesting point because the analogy between what happened to China, what happened to Japan, where in the around 1989 or 90, it was about 18% of global GDP. It's now under 5. I think China peaked out around 18 or 19% of GDP and is now declining. And the fundamental factor that is driving both of those is demographics. And a lot of what Thano mentioned is part of the strength of our economy is that our demographics are better positioned than these other countries. And Europe is fighting this as well, too. And, it's a trend that has made it very difficult to play the international market, the non-US markets in reality. This has tended to be the show.
Yes, and the details, demographics play an important role in details. One, real estate bubbles can't survive a demographic bust because real estate is used by people, and it tends to force you to maintain, if you have a lot of fixed capital stock that you've already built that you need to use, the overall demand in your own economy is shrinking. So you have to export as a way to, sustain the industries that you have. And Japan was like that, and it eventually reached its natural conclusion where demographics and the overbuilding of a mercantilist policy, led to this kind of dead end. And China seems like it's at the early stages of the same thing.
Yeah, I'd like to add that it could be even more positive for the U.S. economy and stock market than it was in the 90s, because at that time we were shifting away from Japan and some of the little tigers, and we were just opening up manufacturing in China that was just getting started. This time the political winds are completely different. We are done with globalization. We are entering deglobalization, and we are bringing that manufacturing back here, where the investment outlook with the best financial capital markets in the world, the best rule of law, and you're closest to your market, your end market, could result in kind of a renaissance in the manufacturing sector and result in, pretty good times for the United States. So it rhymes with the 90s, but in some ways it's different and could be better. Now, again, it is funded this time with deficits, unlike the late 90s when we were running surpluses. But so far, it hasn't disrupted the U.S. Treasury market.
Let's shift to Amory Conti, who is Director of Research for Sendero, and we can talk a little bit about the portfolio performance, and where we've seen opportunities.
Yeah, thank you. As we've been discussing this glide path and kind of comparing where at the beginning of the year when we had our events, and in some way it should not be a surprise that we have not made any major changes to our portfolios, meaning we haven't made a lot of changes to our asset allocation. Now, having said that, what we've done, if you look at the portfolios and the way we think about it, which are these detailed asset class, so stability, growth, and diversifier, we're really taking a look at each one, and we have made some enhancements, some small changes on the edge, and some of that, for example, if you look at our stability, which is cash and fixed income. Cash, and in this case, money market funds that we utilize across the board are still attractive. And the potential for a rate cut in a couple of months is coming up, but cash is still attractive even at these levels. What we've also done is really taken a look at our credit exposure. So this is sitting a little bit outside of our kind of traditional core fixed income, whether it's on the taxable or the tax exempt side, and enhancing, and we've added, and we'll continue to be adding some more kind of income credit strategies that can take more opportunistically take advantage of what could be ahead of us in the second half or in 2025. If I were to switch to our growth allocation, we've been favoring, and really it started last year, where we've been favoring active over passive, to a lot of the points that Patrick and Thano have talked about. And what I do, what the team works with the rest of our portfolio management team or investment advisors, is really going down at the manager level, sometimes the style, the sector specific exposures. As Rodrigo mentioned, talking about the valuations and really making sure that when we do have these mix of different managers, that we think about them from a portfolio standpoint. We've been looking at our natural resources equities, our small cap exposure. So it's really been an exercise of being disciplined and making sure that we're staying with our targets or as close to our targets as possible. And then finally, looking at our diversifier strategies, there's a lot of opportunities. And I think we've been fairly happy with the performance of our current slate of managers. We've seen the dispersion, these opportunities on the long short side, as PK mentioned. On the commodity side, we've seen some great trades between cocoa, natural gas, copper, and other ones. And some of our managers have been able to take advantage of those. So if you look at the allocation itself, it's actually been in 2024 so far really being a positive contributor to performance, which has been great. And then finally, just from an opportunity standpoint, yes, we, as I mentioned, we have a little bit of cash. Whether it's a market correction, which is a 10% correction, so given where we are, basically 5,000 on the S&P, but also outside of that. So on the credit side, on the private side as well, I think there's some opportunities for us to add some exposure in the portfolio that we've had not in the past. And when we think about these investments for the next couple of years, I think we're pretty excited about what those can contribute to that portfolio.
Rodrigo, can you tell us a little bit about some of the dynamics that are happening within the portfolios themselves? And, I did emphasize earlier that we're well above even what our bull case was in the year. But that has triggered some action by some of the active managers, I think, as well, too. So I'm going to turn it over to Rodrigo Lopez, who is Director of Due Diligence on the investment managers.
Absolutely. And I think, John, that's spot on with what we see into what has been morphed or has morphed into a tale of two markets, really. And in 2024, it's AI and then everything else. In portfolios, we address that exposure with a couple of different levers. The first one, which is the core of the portfolio, is the total market exposure for clients. So that is just it's an ETF. It is a passive solution that captures the performance of the entire market. So that has been a fantastic driver of returns because the market has been very solid in the first half of 2024. The largest generator of alpha in portfolios, meaning outperformance versus the index, has been our growth manager. And we're going to categorize growth and value to make a point about exposures, but our growth manager has been repositioning the portfolio since really late 2022 to take advantage of some trends, especially in AI and technology, that have been very beneficial for clients. That is, everything from the chip trade to artificial intelligence, some other communication services stocks that have benefited from the theme. And that has prompted a significant measure of outperformance for the year. The biggest contributor in portfolios continues to be NVIDIA. NVIDIA was up about 150% in the first half of 2024. Our manager actually trimmed NVIDIA 3 times as it became the largest position in the portfolio and exceeded at 1.15% of the strategy allocation. So that's been one of the effects of this performance. And on the other side, what we like to refer to as the barbell is our value managers and the value tilt of portfolios. It captures basically the everything else piece of the market that has been largely ignored as people chase artificial intelligence and technology returns. These managers trade at a significant discount to the S&P 500. That discount ranges from 45% to 25%, depending on the mix of technology, along with other sectors. And these managers are fishing for opportunities. So we've seen this environment of dispersion a couple of times since COVID, and it's really fertile ground for idea generation. So the tee up in portfolios is very favorable to keep taking advantage of the run up in technology and also introducing new ideas at lower valuations using the rest of the managers. So the exposure between growth and value along with the passive has created a very favorable barbell positioning in portfolios. The first half has been very beneficial on one side, and as we see some pickup in volatility, we would expect our value managers and the new ideas introduced in the portfolio to really play out for the rest of the year and into 2025. And overall, that creates a very balanced portfolio in terms of diversification and sources of returns. And the last piece of performance we've seen, this has been very different from years like 2023, where sort of almost everything went up. In our diversifier allocation, like Amory mentioned, the dispersion and the pockets of dispersion have been pretty significant in pieces of the market. So our hedge funds and our other alternative managers have been able to capitalize on these pockets of volatility to create uncorrelated returns that are a little short of what the S&P has appreciated for the year, but they generate uncorrelated returns that have been pretty persistent throughout the year. And that's the positioning in portfolios. We've seen very favorable idea generation, a lot of managers taking chips off the table, so locking in some of those gains of names that have appreciated and introducing new ideas in the portfolio, which is a healthy part of the portfolio construction process.
Great. Thank you. That's very helpful and very informative. Just to wrap up, I just want to make clear that, we always welcome questions from our clients and our audience. Don't hesitate to contact us. We're glad to go down any of these paths and talk in a lot more detail. But I want to thank all of the participants for participating today, and more importantly, thank all of our audience for listening. Thank you.